bankers and market movers. This is The Pulse with Francine Lacqua.
Well, good morning, everyone, and welcome to The Pulse. I'm Francine Lacqua here in London with the conversations that matter, and here's what's coming up on today's program. Fed Chair Jay Powell unleashes the bulls, signaling a pivot to reversing the steepest rate hikes in a generation. Traders now price 150 basis points of cuts next year. European stocks rally. UK stocks look set for the biggest surge of the year. The DAX and the CAC hit record highs. And it's decision day for the ECB and the BOE. Do they push back on rate cut bets or follow the Fed? Plus, Hungary could oppose a European aid package to Ukraine as EU leaders meet in Brussels for the final time this year. So it's very clear we're looking at a monetary policy pivot for the first time. Wall Street, but also Fed officials seem to be aligned that cuts are on the table. That's repricing and changing everything. Certainly in Europe, you can see a nice little boost. We see record highs for a lot of these indices. But the FTSE is almost getting some 2%. The CAC 40, 1.2% higher. And again, this is on the back of already a pretty strong rally. This is what we're looking at in terms of live pricing. So the CAC and the DAX at a record high. We'll have a good look at what this also means for Euro. So I think we have that. There you go. It's just always good to look at what this means in terms of record. 479 for European stocks. You can see the DAX at a record high, and so is the CAC 40, 7,619 points. Now, in terms of central bank, a little bit later, we have the Bank of England. We also have, of course, the ECB. We're also getting the Norges Bank rate decision breaking as we speak. And they basically are suggesting that the rate may be lowered earlier than they had thought. But for the moment, that interest rates is pretty much, it's been raised to 4.5% instead of the 4.25 that it was estimated. So it's interesting the way Norges Bank is trying to position itself, saying that the rate may be lowered earlier than currently seen, but at the same time, for the moment, they're actually raising it up. So medium short-term risk to, I guess, inflation. But then it's clearly that they also see the trend downwards for next year. So lots of central bank action. That's probably the understatement of the decade. Lots of action today to dissect it all. We're joined by Katharine Neiss, Chief European Economist at PGIM Fixed Income, and Jamie Rush, Chief Europe Economist from Bloomberg Economics. I mean, it's a bit of a whirlwind because we have so much to grapple with. And Katharine, we have it. I mean, finally, like Wall Street called it right. They're expecting, cuts next year from the Fed, and Jay Powell, said so.
Absolutely. I think the big question is going to be whether other central banks follow suit. I mean, you've just talked about what's happened in Norway. Really, we're not expecting rate hikes coming from either the Bank of England or the ECB, and it's all going to be about the tone. Are they going to have a similar kind of tone that we heard coming from the Fed in terms of what is the outlook for rates? What's the prospect for early and aggressive rate cuts? I think that's a bit more of a question mark, but clearly the Fed is signaling that 2024 is going to be a year where rates are more likely to be lower than not.
Katharine, I think the only question we have, and I want to put that to Jamie, and I know we have also Maria today on the ground at the ECB press conference for later, are they doing it for the right reasons, i.e. inflation coming down and they want to give themselves a little bit of room, or are they actually going to cut rates for the wrong reason, which is looming recession, if we're not already in a recession when the Fed starts cutting?
So I think for the U.S., it is very much a case of adjusting peak rate and that the prospect is still there for a soft landing. You can see it, for example, in the jobs data. It looked reasonable, but if you kind of strip out what you might think are structural drivers of employment, there is clearly cyclical weakness. But I think the prospect of a soft landing in the U.S. is still possible. The story in Europe is really very, very different. I think the only scenario where we could see really early and aggressive rate cuts coming out of the ECB is if we think that the euro area economy is really going to start to deteriorate from here. That would not be my base case. I think we're seeing signs of bottoming out. But, that will depend on what data flow we get over the coming weeks and months.
Jamie, your team has done an outstanding job really in getting right what the BOE will do when many have gotten wrong in the past. I mean, we have now aggressive pricing in the markets of how many cuts the Bank of England will do. Is that correct, or is the market just getting ahead of themselves?
Well, I mean, I think it's important to recognise the Bank of England has a slightly different scale of problem relative to what the Fed and the ECB are seeing. I mean, the ECB
bigger
doesn't.
problems?
Yeah, because we have very strong wage growth here in the UK that isn't showing signs of really ameliorating too fast. Eurozone obviously is very different. They don't really have a wages problem. They're free to do what they like. So I think the bank they're unlikely to be able to cut on the same sort of timetable as the Fed. I mean, inflation is going to be 4% well into next year. I think it's much more likely they'll have to go a little bit later. But are markets right to expect that perhaps they'll do it a bit sooner than they previously thought? I think that's a reasonable expectation. I mean, what we're seeing, and one of the things that struck me from the Fed was this emphasis on forecasting back on if you wait till you get to 2%, it's too late. I mean, that applies for all central banks. So if there's more emphasis on the forecast, then that'll free the Bank of England up to do a little bit earlier.
But, and again, Jamie, this would be the BOE cutting into a recession for the UK, or are they just cutting in line with inflation?
No, I mean, I think that the outlook for the UK is pretty poor. We do have a recession in our forecast. It's relatively mild, but it's a recession nonetheless. So the Bank of England will certainly have the capacity to cut on that basis if they want to.
Katharine, how much do you worry about the Bank of England and the prospects for the UK?
I mean, I'm really quite aligned. I think that the outlook is pretty much more of the same into 2024, what we've seen for this year, the economy moving sideways, barely registering positive growth, inflation continuing to come down. But, as we've said, the UK does have a bigger inflation problem. They probably paused a little bit earlier relative to that inflation problem, earlier this year, which means that they're going to need to be, higher for longer relative to other central banks. But, of course, in the scenario where things really deteriorate from here, I think the Bank of England would be on it. I think they'd be early. I think they would be aggressive. But I'm not convinced that we're in that space yet for the UK.
Let's head over also to Frankfurt. The ECB up next with Christine Lagarde and colleagues, of course, facing this deteriorating economic outlook for the euro area with this backdrop of rapidly slowing inflation. So let's get straight to Maria Tadeo. Maria, I guess I don't know whether Madame Lagarde will push back against this idea of rate cuts. If she does push back, she'll have to forcefully push back after what we heard from the Fed. But also they have they have to phase out PEP, and so it'll be interesting how she deals with that.
Absolutely. And you see it's complicated for the European Central Bank today. Forget about the monetary policy decision itself. We know they are going to hold. And the entire morning, by the way, we've talked about the cuts going into 2024. So already that tells you a lot about the zeitgeist. Francine, this is a central bank that is obviously going to have to respond to a pivot that has been made by markets already. We've long moved from this idea of higher for longer, higher rates to now fully going into cutting rates. And as you know, there's some that believe you could even see a rate cut in March next year, depending on how the economy deteriorates. So obviously the forecast, too, which will be presented today, will matter in terms of the narrative that they want to paint, but also just how credibly they want to push back to this idea of earlier cuts, if that is indeed what the European Central Bank wants to do today. Remember, we will get projections for inflation for 2024, 2025. That is crucial in terms of signaling that this is a central bank that is now convinced they will get to the 2% target. Remember, there are fears in the Governing Council that cutting too soon, being pushed by markets into cutting, could be dangerous too, if that means they do it too fast and undo the work that they've done today. When it comes to the PEP, Francine, I think you nailed it too, because there is a sequence now, and it's almost understood that the PEP will have to be changed, brought forward, accelerate the ending before you're able to cut. Is this a day where finally the ECB gives the signal that this will happen now? Remember, the markets have been positioned for it for months, but of course it is a complicated one, because today it's all about forget about the monetary policy decision, just look at the communications. And the Fed yesterday, of course, has increased this pivot. Can they push back? Will they want to push back? Or actually, do we get an ECB that says, yes, cuts are next, but we just cannot give you a timeline for the time being?
Maria, thanks so much. Maria Tadeo, our Bloomberg Europe correspondent. Maria, I have this thought in my head every time if you're another central banker and you're watching the Fed and you're watching, of course, Jay Powell, and you're thinking, you're either positive. It's like watching the football. You're either positive and saying he just made my job a lot easier, or he's just made my job tomorrow so much harder. We'll, of course, be bringing you live coverage of the ECB's policy decision, 1:15 p.m. UK time, that news conference with the ECB President, Christine Lagarde, half an hour later. Jamie, I guess when you look, it seems that everything depends on new projections from the ECB simply because we had this steep decline in inflation, but we don't know how much more that continues. So, what's your sequencing of what the ECB does in the next 6 to 8 months?
So I think, just first on the PEP programme, I think now is the perfect moment to make decisions about that. We've got global sell-off or global decline in bond yields. That is the right moment to do it. So I think they'll consider it, and they may make an announcement today, or they may just hammer out some details early next year. On rates, I mean, we're expecting inflation to fall pretty steeply, both on the core measure and the headline measure for the Eurozone through 1Q. That could open the door to a March cut. That is a possibility. So I think we'll be looking for Lagarde for some pretty big pushback from Lagarde today on market pricing for rates. If we don't get it, I think that would be a sign that things are starting to creep forward.
And you agree with that, Katharine? There's going to be a lot of pushback.
I would expect her to have a hawkish tone. Whether it works, I think that is the open question. And I think, ironically, by saying something on the PEP, which I also agree, I think it is quite likely. They've told us in the last two meetings that they hadn't discussed it. Then the President Lagarde went to the European Parliament, said they're going to discuss it soon. So I think it would be unusual for them to come again at this meeting and say we haven't discussed it. So my expectation is that they will have. And on the face of it, it feels like, well, that's quite a hawkish signal, bringing forward the end of PEP reinvestment. This is very much a governing council that's still in normalization mode. But I think, ironically, the market is going to take it as a dovish signal, because by announcing something on PEP now, it effectively gives them the nimbleness, the ability to bring forward cuts early next year if they deem that to be necessary for the euro area economy. Again, it's not my base case, but I think the market will see it as the central bank paving the way, opening up the possibility for them to be able to adjust rates as needed.
But Katharine, given where we are, and again, I mean, I was joking around and, imagining Lagarde going, the Powell is making my job so much harder. But is there anything that the market would interpret as hawkish today, given the general mood out there from the ECB president? They've ignored central bankers in the past.
Yes, I mean, I guess the big surprise would be, anything that really indicates that they are seriously considering raising rates further. Because I think for the market, raising rates now is, pretty much entirely off the table. We are at peak rate, and so it's all about the downside. It's all about the timing of the cuts, the extent of the cuts. So anything that would, lead the market to think, hang on a minute, maybe we don't, we haven't seen, for example, the breakdown of the HICP, the inflation numbers for the euro area. Presumably, they've got pre-release access to this. Perhaps there's some bit of data that they have seen that we haven't seen that would indicate there's a lot more inflationary pressure. But it's hard to imagine what that would be at this moment.
Very quickly, because we need to take a break and then we'll come back more. Norwegian krone is climbing. I mean, this was a surprise hike. Should we take more notice?
I think it's pretty idiosyncratic, and the fact that it's coupled with guidance that they think they may have to cut sooner. I mean, I think that tells you pretty much what you need to know.
Okay, thank you both. Katharine Neiss, Chief European Economist at PGIM Fixed Income, and Jamie Rush, Chief European Economist for Bloomberg Economics. Both stay with us. We'll have plenty more on global central banks and the battle to tame inflation. That's next, and this is Bloomberg. So you're looking at Vladimir Putin there with his annual news conference and call-in show. Now, this is something that we've been accustomed to in the past. It usually lasts 4, sometimes 5 hours. Of course, this is in a different context because his armed forces still on the attack in Ukraine. The re-election campaign is getting way in Russia, and he just started about an hour ago. This is a marathon news conference, basically, with call-in from his constituents. So we'll keep an eye out to see whether there is any news. He's talking about the economy right now, saying 2023 inflation in Russia seen at 7.5% to 8%. Now, we usually cover it from the perspective, from the lens of oil, and the fact that actually they haven't done as badly as we thought, despite all of what the West has tried to do in terms of sanctions. So let's go to Jamie Rush, our European economist at Bloomberg Economics. Also, Katharine Neiss, Chief European Economist at PGIM Fixed Income, is with us. I mean, if you look at Russia, I mean, it's incredible, actually, to see in the last couple of weeks, the Russian president also going to the UAE. I mean, he's trying to take a more international role, still with this, horrible Ukraine war going on. But can you brief us on the economics of the country?
Well, I think so. If you think about what happened to Russia's economy following the invasion, I mean, people were forecasting there'd be a drop in GDP of 10 to 15%. That hasn't happened. We were also expecting that sanctions would limit the Russia's capacity to wage war in Ukraine. That's not happening either. When you look at reserves, they're piling those up in China. There's nothing that's happening on the economic front which is limiting their ability to wage war. But what we have seen from the US is that they think that the Russian economy is perhaps 5% smaller than it otherwise would have been as a result of the war. Why is that?
Which is not huge.
It's not huge. It's not enough to prevent them from doing it. But we are seeing the longer-term consequences of the invasion on the Russian economy, partly because they've had to mobilise so many resources to wage the war. And that we've seen a huge shift out of sort of construction, retail, into fighting the war, and that has, of course, operates as a big drag on the private sector outlook for Russia.
Yeah, it's so interesting. We'll continue, of course, keep an eye on what Vladimir Putin is saying. Talking about inflation, I haven't heard him talk about inflation in quite some time. Katharine, the other big story is, of course, the German economy, because of the budget deficit and the fact that it took everyone by surprise, the fact that the Constitutional Court slammed against it, and then they found a way to work through. Like, where's Germany on your radar?
So I guess the good news is that when we talked about this a few weeks ago, I think the view was perhaps the hit to Germany's fiscal isn't going to be as big as the headline 60 billion euros. So I think that does seem to be the case. It is a smaller order of magnitude, maybe more closer to 15 billion. Nevertheless, against a backdrop of a region that is, really stagnating, every little bit helps. And this is definitely not going in the right direction. Germany is euro area's largest economy. There is a lot of evidence that, papers, academic work coming from the ECB and elsewhere that suggests that what Germany does on fiscal obviously is going to impact Germany, but it's going to have spillover effects to the rest of the euro area. So I think there is a concern. It's not coming at a great time. Near term, it does going to mean other things equal. The economies will be weaker, not just in Germany, but elsewhere. And I think the other spillover effect is how this is impacting on the EU's negotiations around what's the new Stability and Growth Pact going to look like, which could mean that you've got, more austerity to come, perhaps not in 2024, 2025, but in 2026, 2027. So again, that in turn could hamper things like public investment, again, acting as a drag on growth in a region that's stagnating. It's not great news.
So I know we're jumping around, but we just have so much news and countries to get to. The Swiss National Bank, the SNB, I'm looking at the franc, it's pretty choppy, actually. The SNB held rates, but it seems to have been a pretty dovish statement.
Yeah, we look at Switzerland. We don't really have an inflation problem in Switzerland. It never took off in the same way as it did elsewhere. Why? it helps to have a lot of hydropower. That kept electricity costs at bay. But they're not facing the same sort of outlook. So it's pretty clear that they can just sit back.
All right, thank you both. That was a great panel. I could have you on for like 3 hours just to talk about central banks. Katharine Neiss, Chief European Economist at PGIM Fixed Income, Jamie Rush, Chief Europe Economist from Bloomberg Economics. And then at 9:30 a.m. Bloomberg UK will be speaking with the former Bank of England MPC member Martin Wheel. We'll bring you, of course, that BOE policy decision when it happens, and that's at 12 p.m. Coming up, Hungary could oppose a European aid package to Ukraine as EU leaders meet in Brussels for the final time this year. So that's coming up next, and this is Bloomberg. Hungarian Prime Minister Viktor Orbán looks likely to dictate the outcome of an EU leader summit later today. Now, Orbán has been pushing to block funding for Ukraine and obstruct the start of talks for the country to join the EU. Now, for more, let's bring in Bloomberg's EMEA News Director, Roz Matheson. Roz, as always, thank you. So why is Hungary actually rejecting the EU's Ukraine aid plan?
Well, what they're doing is they're trying to tie the funds for Ukraine, unlocking those funds for Ukraine to money they say they're actually owed themselves from the EU. They're also objecting to the idea of committing to a 4-year plan for Ukraine. They're saying that's far too long to commit to financial aid because who knows what the world's going to look like in a year from now. They cite things like the possibility of changes in administration in Brussels itself, the US election cycle feeding into that, and they say it's simply too much and they don't want to do it. However, they are indicating they will negotiate a little bit on the money. They might be open to something in the short term, and that's really important for Ukraine. Of course, we know that also the funding arrangements from the US are very much tied up in the US Congress at the moment. There's been no movement to unlock that aid also, and Ukraine is saying quite simply they need this money urgently or they're going to run out of cash. They're also going to run out of stuff to fund their war machine and the ability to continue to push back against Russia on the ground. So it's quite a high-stakes summit in Brussels that's starting saying today the key really is, can they negotiate some sort of solution for this with Hungary, and for how long?
So also underway at the moment, Roz, Putin's annual address, a very lengthy annual address. What have we learned so far?
Well, it is a 3 to 4 hour affair. He takes questions from the press and then he takes carefully screened calls from the members of the public. What we're hearing so far, very much talking up the resilience of the economy. This is aimed very much at a domestic audience before, of course, he seeks re-election where he's expected to succeed. But what he's saying is the economy is held up very well despite the war. It's showing resilience. He's also saying his goals on the ground in Ukraine have not changed. Very much a message that things are going as business per usual for him. Of course, it's a very different scenario potentially, but that's his message so far.
Roz, thanks so much. Roz Matheson there with the very latest, of course, on Russia. Coming up, the former BOE MPC member Martin Wheel joins us on Bloomberg UK.